Okay, so in this next video, we're going to talk about variable position sizing. So basically, sizing your position or in order to fit the parameters of risk and money management, right? So if we're trading too much of a, too big of a size for a particular trade, we may be risking a lot more money than we should be. So in essence, in order to circumvent this, we have provided you with a variable position sizing along with this course, and it can be downloaded on in module 1. Okay, so if you open up the Excel sheet, there are only two portions of the Excel sheet where we can actually manipulate, where it's in yellow, right over here where it says the account size. So this is basically where you enter in your account size, and over here your percent risk per currency pair. For example, if you're trading the pound US dollar and you want to risk a 1%, then you would enter 1% and it would tell you the amount in dollars of risk per trade. Okay, so in our example, it's $15 that we have of risk. Now, if we move to the pound US dollar column over here, and if we spotted a trade and we have a potential grade setup and we're looking for a 20 pip stop loss, we can size our trade to be, obviously we would have to round this down, so we would trade it down to $11,000 or 10, which you can just round it down to 10. So it would be a 0.1 lot of a standard contract. Okay, this is basically what we use in order to position our size of our trade accordingly, so we are within our risk parameters of not risking more than 2% per trade. This is really important, and I highly suggest you use this tool when you first learn how to trade in order to know what kind of size of trades that you should be placing, right? Because there are basically two ways you can go about this, right? If you have a potential trade that really makes a lot of money for you, this is great, and we use this tool in order to maximize those profits. But on the flip side, if we have a potential loss, we also want to mitigate those losses to as minimum as possible, and this is what we use. We're looking at how much of a stop loss we're looking for, right? So if we're in the area of green, between 10 to 35 pip stop loss, this is a pretty tight stop loss. You're not risking that much money if you're within these parameters. However, if you start going down into the yellow and the other colors, you're risking a little bit more. So your average risk to reward ratio will be a little bit harder to maintain, right? Because, for example, if you have a 100 pip stop loss, in order to make a 2 to 1 risk to reward ratio, you now need to be targeting a 200 pip gain. So targeting a 200 pip gain is obviously a lot harder than targeting, let's say, a 50 pip gain, right? So if I have a stop loss of 10 pips and a target of 50 pips, then right there is a 1 to 5 risk to reward ratio. So it's obviously in your benefit to have tighter stop losses, as you can target higher rewards, and you'll have a higher average win to loss ratio. So, but having a tighter stop loss also could mean that your stop losses are getting triggered more often. So this is really, you have to adapt it to according to your trading style and the currency pair, obviously, as we'll go into in more advanced lessons, that depending on the currency pair you use, it has a different personality. For example, a euro US dollar is a little bit less volatile than the pound US dollar. So for a pound US trade, you would probably want to risk a little bit more just to prevent it from getting stopped out, from being a little bit more volatile than the euro US dollar, for instance. Okay, so again, just to recap, variable position sizing Very, very important, especially when you first learn how to trade. You don't want to be risking more than 2% per trade, and we have provided you an Excel sheet in order to properly position your trades.